Alright, let's talk about ARK Invest's expectations for Zoom video communications, aka Zoom. They expect that ARK's stock price in 2026 in their base case is going to be $1,500 per share, with a bear case of $700 per share and a bull case of $2,000 per share. They derived the bear case and the bull case from Monte Carlo simulations tuned to the 25th and 75th percentiles of the results of those simulations. But let's see whether we can figure out how they got to these projections. They publish all their research. As it said above, it's about a 41-minute read, and I want to spare you that. So let's see whether we can shortcut or short-circuit how they came up with this. Now, $700 in the bear case, which is what I will be mainly looking at, is about a sevenfold increase of today's stock price on June 30th, 2022, which is $108. So that would be a tremendous return in 5 years. Technically, there's only 4.5 years left, but let's say it's 5, and you got 700 over 108, that's 6.48, and that in 5 years, that would be an internal rate of return of 45%. So that would be a tremendous return if you could get it. The question is, can Zoom get there? In order to do that, let's look at the data that ARK Invest is using. It looks like a complex graph, but it's easy to dissect. The entire bar here is for 2021, and the height of the entire bar is the number of knowledge workers that ARK estimates that there are in the world, which is about, whatever, 480 or 490 million people working in knowledge work. Of those, maybe 200 million currently use Zoom, but only a small fraction, what might that be, maybe 33 million or something like that, pay for the services that Zoom is providing. Now, this here is their projection for 2026, specifically the bear case. What you see is that the entire number of knowledge workers is expected to grow quite strongly. It's about 60% growth, which is a lot, to be honest, but who knows whether that's possible. And it's not that important either. More important is the increase in Zoom users. They actually assume a fairly modest increase in Zoom users, from 200 to maybe 250 million in the bear case, but they assume that Zoom can convert a lot more people to paying users. So this looks like it might be something like 85 million, eyeballed, 85 over what is currently 33 maybe. So let's go here and say 85 over 33. That's a factor of 2.576 times paying users that they would get. And they also expect, that's the blue line here, a strong increase in the revenue per paying user. So that's denoted on the right-hand axis. Average revenue per paying user today is around, what might that be, 120-ish? And they expect that to increase to something like 320 maybe. Okay, so 2.576 times 320 over 120 is 6.869. So let's multiply that by today's stock price, which is 108, and you get 741. So this is how you roughly eyeballed, get to a sevenfold increase in the stock price. It's about nothing else than an increase in revenue, and that increase in revenue comes from some increase in users, a drastic increase in paying users, and a drastic increase in the average revenue per user. If you don't believe in that, that whole case falls flat, and you don't believe that they can get there. Now the question is, can they get there? You know, everyone can make these projections and hoping for the best. But if you are a subscriber in the efficient market hypothesis, then you believe that at any given point in time, a stock price reflects all the information that is available about a stock or about a company in the market. And if that were the case, and Zoom should be a $700 stock in 5 years from now, then it should probably be trading at somewhere around 400 today. So if it were a $700 stock in 5 years from now, then it being only 108 would have to mean that the entire market or large parts of the market are underestimating what's going to happen at Zoom, or else it should be much more expensive. Clearly, since you can buy it today for $108, the question is why? What does the market believe, or are maybe ARK's beliefs or projections unrealistically optimistic about the company? Because if you subscribe to ARK's model, then you should buy the living hell out of this stock, because 45% return per year is nothing to be trifled with. You get very rich very quickly with these kinds of returns. So let's look at how realistic this might be. As for cash flows, last year Zoom generated $1.46 billion in free cash flow, but you see that the year before that it was not much less. So growth in free cash flows was not that high. And in this year it might reach something like 10 or 20%, because that only contains 1 quarter in this fiscal year, but it doesn't look like it's going to be exorbitant. Remember that in order to get to a 7-fold increase in revenue, we would have to grow roughly at the same rate. We would have to grow at something like 45%, 45 to 50% per year. And it doesn't look like, in terms of free cash flows, that they can do that. If we look at the income statement, in terms of revenues, it's more interesting. Then it looks more likely that they could do that, but then it becomes a question of whether they can convert revenues into profits. So from that perspective, a little bit more interesting, even though to this quarter from last year, including the first quarter of this fiscal year, it looks more like a 10 or 15% growth compared to what it was in the last year. Okay, so let's look at their balance sheet real quick. They have $5.78 billion in equity, and invested capital is estimated to be the same, and they generate $1.46 billion in free cash flow. Let's create the relation of that. 1.46 over 5.78 billion equity. That's about a 25% return on equity or return on invested capital. Since they didn't pay any dividends and didn't buy back any shares, they retained all of these 1.46 billion free cash flow last year, and should generate or would generate an expected 25% on it, which would be $365 million extra dollars. So we might expect free cash flow to fall somewhere in the $1.8 billion range if that came to pass. But in any case, it would mean that 25%, conservatively estimated, we should expect a growth rate of 25%. So let's see, starting with that growth rate, what we can come up with as a value for Zoom video communications. I'm using my own valuation tool here, programmed this little app. It takes growth scenarios, and you can play through growth scenarios and see what the valuation is at the end. So I'll assume a 5-period model, and we'll start with 25% growth. And we'll descend that into terminal growth of 2.5% per annum. And then we'll fill in the gaps, and I'll arbitrarily use, I will admit, 15%, 10%, 7.5%, and 2.5% to make a smooth and decreasing descent into terminal growth sort of thing. And I'll say, you know, I might be off on these growth rates, cash flow growth rates, these would have to be, and say that I could be off by 5% on the 25, by 3% on the 15, by 2% on the 10, 1.5% on the 7.5, and 0.5% on the 2.5 terminal growth. Discount rates, Zoom is a member of the NASDAQ. NASDAQ long-term average return is 11%. I do not subscribe to the weighted average cost of capital. They make no sense in valuing stocks. As an investor, you're thinking about the internal rate of return, or the rate of return that you could make in an alternative investment that is in your opportunity costs. You're not thinking about internal financing like the firm does, thinking about I take so much equity and so much debt on for this project, and therefore what is my weighted average cost of capital. I find these completely nonsensical in valuing stocks. Period discount rates, therefore, let's say for the fast-growing periods of 25 and 15%, we'll assume NASDAQ rates 11%. And then for the slower-growing periods, where then maybe we would suspect them to be in the S&P, or at some point maybe even to get in the Dow if they get really huge, to be on the order of 10%. That includes dividends, if you will. So that's a proper discount rate. I say I could be wrong on these and just give myself a wiggle room of 1%. 1% is a bit much, let's say 0.5. Around these values, that should be sufficient. And then period lengths, here is where it gets interesting, because more growth for longer periods of time will drastically increase value. So since we at least try to look at what might come out of this model, if we at least put a starting point similar to ARK, let's believe they can grow 25% for 5 years. And all the other periods other than the terminal period also 5 years. So they'll grow for 5 years each, 25, 15, 10, and 7.5% with the error rates around it, over which we will run simulations. And then let's say I'm not sure whether the period lengths are accurate and could be longer or shorter by 1 year in each direction. Then we need to supply some optional values. They're not strictly required, but to actually get to the value, we need to give it these current metrics. The current free cash flow was 1.45 billion. Current market capitalization of Zoom is 32.2 billion. And cash net of debt, cash and cash equivalents, 5.4 billion. Total debt 105 million, so there's 5.3 billion of a wallet that you get for buying the company. That's of course nice. Dilution, that's about shares issued. Here it was maybe 3, 4, 5% between 20 and 21 and 2%. Roughly 2% in fiscal year 22 or what that was. So let's assume they'll do 2% over the high growth period. I think that's a fairly fair assumption to make for a growth company. So for the first 2 periods where growth is high, and then we'll assume they get into either paying a dividends, buying back shares, or at least not issuing new shares, or that holding the balance, whatever it may be, but not issuing new shares. after the first two periods, which are 10 years long combined. So let's say they dilute 2% over 10 years and then they stop. Let's see what comes out of it. With this model, we believe that diluted and adjusted Zoom today is worth $81.1 billion today. That is still a very nice difference to its current price of 32. Right? That would imply an upside of 152% over its current price. The question is, do you believe this growth scenario? Clearly, the market currently paying 108 does not believe this growth scenario. If they believed it, the market should be paying on the order of $260 for the stock today. So one interesting aspect to note is if you're believing in the efficient market hypothesis, then at any given point in time, the market reflects all available information. And when you buy and can buy a stock in the market for 108, meaning at 108 you are the highest bidder and you're meeting with the lowest seller, what you have to ask yourself always is, why am I the person that is most optimistic about the future of that stock, of that company, at the point in time that I'm buying the stock of that company? Well, so clearly we're far away from the 700, or discounted to today the 400, that the stock should be worth if it were even 700 in 5 years from now. So the market doesn't believe the story that ARK is projecting, and neither am I with quite optimistic assumptions, I would say. 25% growth is not to be trifled with. It's not a small assumption for growth. And Google grew, after going public, 35% maybe for 5 years, and after that they grew 22% or so on average, compound annual growth rate, for another 15 years or so, and that's tremendous. And there's no surprise that if you assume that Zoom is going to grow like Meta or Google or Microsoft, then its stock price is going to develop like Google or Meta or Microsoft, for that matter. And you'd get the returns. The problem is if you draw, companies often enough, let's say 100 companies of that nature, then maybe 3 develop into Google, Microsoft, and Meta, and the other 97 do not. So you might get it wrong on that one company, but you're not going to get it right and lucky on all the companies that you are looking at. So this idea that you can consistently pick 10 baggers that you know are going to be 10 baggers is not going to happen. You might buy something, look where it goes, and then get lucky or reevaluate. But to say today that this is going to be a 10 bagger in so and such and such time, that is somewhat hubristic, I would say. That requires a bit of hubris and not so much knowledge. Let's look at the outcomes of the simulation here. So our growth scenario, running growth with the arrows all around, from the min error to the max errors, more or less, because it's all drawn random numbers, indicates a fair value for Zoom somewhere between $50 billion and $157.3 billion. Today it's only trading at $32 billion. If you believe that they can make even this growth scenario over 20 years that I outlined here, then you'd think this is undervalued and you'd still buy the hell out of it. Yeah, even more so if you believed in the ARK scenario. But clearly, this is not what the market believes in. The market believes in a much more modest scenario. In fact, we could try to recreate a scenario that follows or that projects the valuation that is currently being paid for Zoom. Let's do that quickly. Why shouldn't we? Let's assume this goes down to 20%. 12.5, 10, 7.5. Let's see where that gets us, and then that's still way too high. 62. That's still double of what is suspected. 15. It's still way too high. So let's shorten the periods, because I think 15% growth is realistic. The question is over what duration. So let's make this 3, 4, 5, and 6 years instead. So we shortened the high growth. We're shortening the high growth periods. Let's see where that gets us. That's still 45 billion. So that's still too good, too long based on current cash flows. Yeah, that's more in the ballpark. I don't want to fidget with it anymore. So if you believe that it grows 15% for 2 years on average, 12.5 for 3, 10 for 4, and 7.5 for 5, then you get its current valuation, roughly speaking. We could rerun the simulation so the figure is no longer accurate, but I don't think it's worth doing. So even then you would think that it's currently about 20% undervalued. And I think this is a growth scenario that you could much more easily subscribe to and be convinced by and say, you know, I'll put it in my portfolio, I'll see where it goes, and as it goes, I will reevaluate rather than put assumptions into it that will make it go to the moon to begin with.